everybody, and welcome to this fantastic event that Think Markets has organised for you. Our Louise Bedford is buy and hold dead webinar, and it's probably never been a better time to answer that question, or at least not in the last 15 years anyway, since the GFC was upon us. And I do feel that markets like this can teach us many things. And one of those is that the old buy and hold technique, buy, hold and hope, is not always the best scenario. Certainly in a bull market, it is good, but when markets turn to bears, you've got to find a better way. Otherwise, you are destined to repeat the mistakes of the past. And our guest today is certainly somebody who has seen many cycles through her long career now, spanning over 30 years, a best-selling author, over 5 books published now, a couple of which, I shouldn't say just a couple are on my bookshelf, Louise. I should say they're all on my bookshelf, but a couple are on my bookshelf. And, you know, in this day and age of the hoodied finfluencer who's been around for a whole 5 minutes and appears to be an expert, what a refreshing change to have somebody with her experience and to boot a degree in psychology and business as well, to perfectly applicable fields for what we're about to do. And over those 30 years, Louise has helped thousands of investors via her mentor program and her podcast. I'm sure she'll tell you more about those as we go through. But total hands-on and caring approach to get you from buy and hold to treating your investing like a business. Before I do throw to Louise, I've got to do the station sponsor announcements. I mentioned people that hang out with me. If you're not a person that hangs out with me, you can do so for an hour, a little bit over an hour, typically, while I answer your questions. So it goes as long as you have questions on Tuesday at 1 p.m. There's the link to register. Think Markets, if you don't know who we are the good guys in the Australian broking scene. You can trade shares with us. So on one side, you might have your self-managed super fund. You can trade that HIN and CHESS sponsored. So none of those aggregating your very valuable and important self-managed super fund holdings with everyone else. You own your own shares, $8 flat rate trades. And, in the same platform, you can have a CFD account going as well, where you can use our CFDs to hedge your shares, very important in a bear market, or trade indices, commodities, futures, crypto, and lots of other stuff. We do have market-leading spreads and commission-free on share CFDs, very unique out there. We are an award-winning broker. We haven't been around for 5 minutes. We've been around for many, many years. We have offices all over the world. We just opened one up in Japan. We are regulated all over the world as well, including, of course, having our AFSL over here in Australia with a Melbourne-based office, and me over here in Perth, dedicated account manager, world-class trading apps, and head to thinkmarkets.com.au for details. If you are new to Think Markets, we do have a 10 free trade for new clients going at the moment, but we're going to kick in an extra 10 free trades for people who are registered today. Terms and conditions apply. Just ping support at thinkmarkets.com for further details. If you're watching us on YouTube or any of the other social media channels, please hit the subscribe button to stay notified of any future updates, whether you're watching this on Louise's channels or the Think Markets channels. And make sure you hit the like button as well to let us know you like what we're doing, so we'll continue to do more of it. That's really it for me, Louise. So I invite you to take control now and jump into your presentation.
Sure. Well, look, firstly, I'm just so excited about being involved today. There's been so much talk about the markets, and it has just been quite devastating for so many people because they are seeing their money dissolve, and I know what that can feel like. So I'm really excited to discuss with you some easy methods that you can use in order to turn that around for yourself. So what I'm going to do is I'm just going to open up my presentation and I'm going to share my screen so that everybody can have a look. All right, so this is what we're going to discuss today. Is buy and hold investing dead? So some people have a variety of different portfolios. Some people enjoy having that longer term view, and I do understand that, and others enjoy trading very short term. So I think think about where you're situated on that continuum. And I'm going to throw in some information for every single person involved. So I'll just give you a bit of background about me. So a lot of you will have had at least one of my books on your bookshelf. Carl, you and I have known each other for, I think it's over 15 years. And it's just lovely to hear that somebody of your caliber is still enjoying my books and getting a lot out of them. That actually brings joy to my heart. So wonderful to see. And way back when I started trading in 1990, I had no idea that trading would eventually become my key source of income, and it would give me everything that I needed to be able to sustain my lifestyle. And it also allowed me to become a full-time parent, to bring my husband home from work, which was just lovely, and for our kids to have never known working parents. So I don't know where you are on your list of priorities, but for us, that was number one. So to have trading be able to provide that is just wonderful. So I just want to make sure that everybody does understand that this is not specific advice, it is general advice, just the way that Carl and I just discussed then. All right, let's get into the meat of it. Now, if you've ever been to a financial planner and you've seen on their back wall, pretty much all of them have this poster of these ever increasing returns. $1 invested in 1956 will be $5 billion today. So that type of study is really interesting because it doesn't take into account whether you stayed in for the long term, whether you stayed out for the best days or in for the best days, and out for the worst and in for the worst days. So I'm going to give you some information here that is going to blow your mind. Traditionally, that entire area of financial planning has been selling you something that is not a full truth. And I want to get you to question that. It's really important that we have facts here as traders so that we can enjoy specific information that we can act on. Now, the idea is with this is I'm going to show you this next chart, and it's going to give you the proof you need. That middle blue line is if you just bought the index. Now, that top red line is if you missed the worst days in the market. So just let that sink in for a minute. If you're missing the worst days in the market, look at the difference. It's almost double. So that is really significant. And what about if you missed the best days? Because that's a concern as well. You are only slightly under that control group. So isn't that fascinating? I just love things like this because it makes you really question what are the techniques that we can use to make sure that we miss those worst days and that we also stay in for those best days so that we can continually outperform the market. And just to give you a bit more information about how that works is if we have a look, and you'll see the time frame that I've taken with this particular piece of data. I've taken this in boom times. So there's no point in staying out in the worst days if it's only going to work during downtrends. What about if it's only going to work in uptrends? We need to actually have a look at an uptrending time and see what happens if we can skip the worst days and also compare that for the longer term. So you can see if you miss the best 40 days, that's an 8.23% return compared to a buy and hold of 17.89%. Now, that to me is fascinating because buy and hold is outperforming missing the best days. So now if we can just work out how to miss those worst days, we're going to be in a position that gives us the best possible result. So I know that's what you're here for. And I know you probably didn't need that background because part of you senses this. Part of you knows that I'm right. We're not just talking about a financial impact, we are talking about that emotional impact. You know what it's like in the markets when you are hit with a loss and it's a big loss and you can feel constricted. I've been trading for so long, still now I feel it change my breathing. I noticed that all of a sudden my heart rate is really there and it's just pounding in my ear as well. That type of feeling, those emotional but physical transformations, that is what we need to avoid. Because to be an efficient trader and to really get those results, what we need to do is make sure that we don't have those massive swings high and massive swings low, that we have that stability of emotion and we can regard things with objectivity. So hopefully that gives you a bit of an idea why we're here today, and it'll give you a concept as to why I'm so passionate about it. All right. So let's look at how we can avoid those worst days. And one of the key ways is looking at a macro filter. So a macro filter is really important, and I'm not sure how many of you use it, but it is something that I find is absolutely sacrosanct. I find that without that ability to tell me when to trade and when not to trade, that is when I can end up in trouble, because then I'll be trading at inappropriate times. I'm going to give you my macro filter and you're going to love this. It's something that you can easily apply, but just before I do, I need to give you some definitions. RSC, so that's relative strength comparison. So it's comparing two things and seeing whether one is outperforming another. Okay, so it's not RSI. RSI is relative strength index, and that is a separate indicator. So RSC is relative strength comparison. Another definition, average true range. So this is on average, how much do the shares go up and how much do the shares go down on an average day or an average week. So we're saying on average, it looks back over 15 or 21 periods usually, and it'll give you an absolute figure. It'll give you like a number of cents. So I'll give you an example. If you've got a $10 share and your average true range is 10 cents per day, that could go up to $10.10 or down to $9.90 on an average day. And then the only other one that I want to give you, because I don't want this to be a massive technical thing, I want this to be implementable, is the ATR percentage. So that is looking at that 10 cents. What is that as a percentage of the overall share price? So they're the key terms. And I'm going to take you through a chart right now so you can see how that works and how I implement it. So here we've got a chart of the All Ords. Now, some of you might use the All Ords, some of you might use the ASX 200. It doesn't really matter which one you use for your macro filter. The All Ords has a rebalancing that occurs once a year, and the ASX 200 rebalances each quarter. Now, it's interesting at the moment, this is the biggest rebalancing I have ever seen in the markets. There were 30 instruments that were taken out of the ASX 200 and put into the ASX 200 in the last quarter. That is extremely rare. So hopefully you can imagine why that would be. So many companies struggling, dropping down out of market capitalization and not qualifying to be in that top 200. So let's look at the All Ords, because these two charts look very similar, the All Ords and the ASX 200. We're looking at the shape, but we're also looking at those three key areas that I mentioned. So this one shows as a percentage, what we're looking at is it's only per week 3.17% in terms of volatility. It only goes up or down by 3.17%. Now, I was surprised by that. When I first started looking at this type of thing, there were definitely times where I've gone, my gosh, am I the only one where my market volatility is going up and down by massive amounts? It's because this is an aggregate. So some things barely move and some things go ballistic. So I've developed a rule for myself, and you're welcome to steal this rule, that when the All Ords has over 5% volatility, then I do not trade. So let's look back into time. So in the it's like way back when, in 1997 it did it, but in the 2020, around about the March 2020, have a look at those solid blocky candles that just go down and down and down. They're the ones that push that volatility up because of the length of the candle and the repetitive nature. It was just long candle after long candle. We know volatility is not directional, so we need to combine that with the direction of that chart. So I use a moving average for that. I use a 30-week moving average over the top of the All Ords. And if it's above its moving average and volatility is less than 5%, then I'm allowed to enter long positions. I'm allowed to trade shares, for example. If, as currently we're experiencing, the markets are showing activity underneath the All Ords on the moving average, then that is no go for me. I'm not allowed to enter new positions. Technically, on the percentage of the ATR, I could, because it's under 5%, but that moving average keeps me out of the market currently. I have some positions left. They're still swimming against the tide. Go to it, babies, keep going. But in terms of entering new positions, I'm not actively entering new Australian positions at the moment. And hopefully you can see that rule. So Carl, can you just give me a little bit of feedback? Can everybody who has a rule like that pop into the chat area? You have a macro filter. Give me a bit of feedback here. So now we're saying 5%. So is that 20 BPS movement? The percentage is based on the actual chart itself. So it can take into account the cents and the dollars of the chart if it's actually a share chart. But if it's like it's got pips on it or the index points, it looks at the percentage movement. Yes. So have we got a few people saying they've got a macro, or is this all fairly new?
I think it's fairly new. Yeah, it's this idea of you don't have to be in the market all the time, and having a rule that tells you when to be in and when to be out, and then having the discipline to follow it is the other part of the problem.
That's fantastic. Well, look, I'm really, some of my clients are saying, yes, I sure do. So that's a beautiful thing, because the difficulty with this is if we stay in all the time, then we could be in a situation where the market is dropping and we're hanging on for grim death. And we don't want that. We want to trade when the market is not very volatile, but is also showing a clear trend direction. And that is the key. So the trend direction, yes, it is a weekly chart. A trend direction will help you in terms of looking at the moving average. If it's below the moving average, we're using that as a surrogate for it's going down. If it's above the moving average, it's a surrogate, yes, for sure. There's other things you can do here. If you're more technical in nature, remember this is a big, blunt tool. This is your go or no-go type of method so that you can live to trade another day. Now, some of the intricacies with this, let's just see, maybe you'd like to pyramid and you've got an existing situation where one of your little babies is going beautifully. Go, baby, go. Yes, you can pyramid and go against the macro because you've got something that is outstanding and it deserves to have more money thrown at it. Should you close out all of your positions if the macro says no go? I would suggest not. I would suggest you stick to your stop loss, because your stop loss is related to that share price action. And that has to be your harbinger of truth. That share price action tells you whether to stay in that particular share. This only tells you whether to get involved in new positions or whether to back off from the markets. Let's look at the ASX 200, and I'm going to build on this information for you. Now, you can use the ASX 200 as your macro. That would be just fine. What we can see here, it's almost exactly the same in terms of the share price action, or the chart price action in this case. It's the same look. It's under the moving average. And also, I've run an RSC over the top of this, comparing the ASX 200 with the All Ords. And you can see it tracks fairly closely. So whichever one you use will be the right one for you. It's slightly out of adjustment because of that rebalancing. So because of that quarterly rebalancing, that ASX 200 won't be exactly the same as the All Ords. Now let's have a look at what you can do in your trading plan to really implement some of this information. So I do have a trading plan. It's written down. I love following a written trading plan because as soon as the markets are open, it's almost like your IQ drops. And it can get very confusing sometimes if you don't have a predetermined plan. So I'm big on following that trading plan, and I hope you are too. It can tell you when not to trade as a macro, and I would suggest you put that into your trading plan. Another thing I have in my trading plan is my ideal archetype. That is the perfect share, the one that, my gosh, it's so beautiful. You wish you could introduce it to your parents. It's just such a gorgeous thing. I look to match that archetype so that when I'm looking at new positions, does it actually match that archetype? Because if it doesn't get purchased. So that's something to consider. Also in your trading plan, add in your trading system. That's your entry, your exit, and your position sizing. So those three components are the essential parts of your trading system. Now, just as a show of in the chat to give me an idea, just write down whether you are using a trading plan. Just write yes or no in the chat so I can get a bit of an idea here where we're at.
I think now, some honesty and self-reflection is required because your version of a trading plan might not be the same as other people's. So trading plan really defines everything you do on the market. So
we've got a bit of a mixed bag here. We really do. So for the people who aren't using a trading plan yet, come and visit me at my website, tradinggame.com.au, and I'll give you my trading plan template. That will give you the basis for your trading plan. And I know you're going to love it, tradinggame.com.au. Now, even if you are a buy and hold type of person, I do urge you to use a trading plan because it will help guide your actions and it will increase your returns. The research shows that if you're following a template for what to do, when, that you're actually going to put yourself in the best possible position of increasing your returns. The two things I want for you, increased returns and longevity as a trader. And working on yourself as hard as you do your own trading plan, the research shows that that is what this gives you. So congratulations on being here for a start, but now we need to start getting some very specific things implemented so that you can excel in the markets.
So, sorry, Louise, interesting. George has come in here and he said he doesn't really trade. He's more buy and hold. And I think we've actually used that word trading a lot and trader a lot, probably without maybe explaining what it is yet for the uninitiated. And I'll just give you my view, then I'll ask you for yours. I've always said that trading is just investing with a plan. Okay, so traders are investors, but traders are investors with a plan. That's my view.
I love that. I actually don't differentiate that much between trading and investing. Investing typically is a longer term time frame, but I do urge every investor to work out a premeditated exit point before they even get into the markets. Even if you've got in mind you're going to hold this for 5 years, but at what point are you going to consider yourself wrong? At what point are you going to say, I need to get out because that pain is too much emotionally, but also if you lose 50% of your money on the remaining money that you have left, you have to make 100% to get back to break even. So once these things have dropped out of bed, the odds are they're not going to levitate. And you just have to work out what your position is in order to tell you to exit. So there are a few other principles here: portfolio heat, Kelly principle, anti-martingale system. They're really important areas. So if you do want more information, then let's ask about it in the questions. so that we can move on through some of the presentation as well. You can get a bit more of an idea about some of the things that you can do to avoid. So some of the biggest mistakes that I'm seeing right now. So for those of you that are my clients, you'll know that I see hundreds of trading plans. I look after my mentorees. It's a repeat for free course. So this is the 23rd year that I'll be running it. I've got people from that very first mentor program that follow along every single year. So I get to see their development. They share with me their trading plans. They share with me their results. So this is not something that I have plucked out of the air and said, oh, I think. This is actually based on data. It's based on data of hundreds of traders, probably thousands that I've helped throughout the years. So right now, though, people not using a macro are getting filleted. It is nasty. There have been two types of bites in the market traditionally. You've got your shark bite, which bites you in half, and you've got your piranha bite, nip, nip, nip. Currently, we are seeing both. We are seeing shark bites and piranha bites. It's not usual circumstances. So you need to learn how to protect yourself, and that macro filter can really help. And that's why I think it's amazing that Carl is running this. He does care for you. He wants you to actually do well in the markets and to stay a client. So many places do not. So I think that hats off to Carl for this. I'm also seeing people not use, Carl does rock, exactly, not using a stop loss. So some people who have decided to hang on in there for grim death, they are the ones that are really struggling at the moment. Some are even hiding those results from their spouse. I'm hearing of it more and more, particularly if the two of you are not on the same page with money. There are lots of these slip under the bed type of trades that are happening right now. And that is unfortunate to see because that can have a real impact on your relationship. Another place that I'm seeing is people investing in cold sectors. And I have got a resource to really help you with this, but I'll finish off these biggest mistakes first. Some people are not focusing on the hot sectors in the Australian market as well. A lot of people are spreading themselves too thin, and I'm not just meaning in the markets. They're having demands of their boss. They're having to do all of these Zooms, sometimes coming into the office, sometimes not. There's a lot of stretch psychologically for us. And when we're stretched psychologically, we have trouble taking in new information. We use confirmation bias because we don't want to get involved in something that goes against what our confirmed thoughts are. It's quite tricky. Also, trading high volatility positions. That is difficulty there because I believe what is happening right now is that there are so many shocks in the market that often people are getting stopped out, and then that trend is going exactly where they thought it would in the first place. And also not evaluating your performance. So let's just quickly look at which sectors are hot and which sectors are cold. I'm going to give you a little bit of a surface level area here. So let's give you that. For more in-depth, I want you to go to tradinggame.com.au and it's hot or hot. So that is what you're after there, that special report. In that special report, I'm going to give you my analysis of these sectors, which are hot, which are cold, which are in limbo, because there are so many at the moment that are neither. So you need to stay away from the limbo ones and definitely stay away from the cold ones. That is really important. So let's have a look at the hottest. So this is by far the hottest at the moment. Can you see why it is? Firstly, we have got quite a long way before we hit overhead resistance. That's a beautiful thing. That brings joy to my heart. We also have a series of higher highs, a series of higher lows, and that index is above its own moving average. Now, have a look at the bottom part of the screen, RSC. I have compared the ASX 200 energy with the All Ords. It is outperforming the hell out of everything out there, but especially my benchmark, the All Ords. So I'm just hoping for a bit of feedback here in the chat. Is this something that you feel you can relate with? Give me a yes or a no. Are you looking to see what sectors are hot and which are not? Because otherwise this might influence where I take this presentation. Okay, good. So we're getting some yeses. Okay, so hopefully the theory goes, and this is so that we can sort of get that pathway forward about where we should be investing. So we've got, should we be investing? Now we're looking at where should we be investing. So I'm looking at those hot sectors to guide me as to my next opportunities. Interestingly, it's not always the hottest share in the hottest sector. Sometimes you're going to have a little bit of a dud in that group, and that will be lifted up because that entire sector is lifting. So, for example, if you've got something to do with an airline crash in Malaysia, have you noticed that Qantas share prices drop? It's fascinating, isn't it? It's because there's a sector-wide issue there. So I've just got a question here. Does this mean that you would trade in energy even though the All Ords chart is trending below the moving average?
Good
now,
question.
This is a beautiful question. I've picked this out of the bunch because this is important to note. For me, I've got 10% of my entire equity where I can trade against the All Ords. So this is important. I've risk managed because I have minimized the amount of money that I'm prepared to risk. And I'm also risk managing because I'm going for that hot sector. So that 10% of my money, not all in one position, no, 10% in total. That is my, okay, now let's go against that predominant trend, but stack the odds in my favor. That's really important. It is a good question, isn't it? Let's have a look at a cold sector. Now, this is one that it's relatively unfortunate. Information technology. Have a look at this trend. So even if you're a beginner and some of this is going over your head, all right, please hang on in there. It'll just take a little while before you're comfortable with this. You will get comfortable with it. The important thing is to really immerse yourself in this area. Now, good question as well. What stocks are in each sector? In that special report, I give you the lists, so you'll be able to track those through. So go to tradinggame.com.au/hot or not. You'll see my full analysis, every share in every sector, regardless of whether it's hot, cold, or in limbo. So that's important. So let's look at information technology. The poor baby, my goodness, it's underneath its moving average. It's got more red than green. It's got longer red than green. It's got a series of lower highs. It's also got a series of lower lows. And sure, it has hit support here, but it's coming back down towards support again. Just have a look at that RSC compared to the All Ords. My goodness, we are out, baby. We are down, down, down. So if you have shares in this sector, my guess is, not knowing your portfolio specifically, it's probably already hit your stop loss. And if you ignore that stop loss, there isn't that much hope in this sector. So hopefully you can see some of this to really determine where you should be. Are there any screens or tools that you can recommend to determine the relatively strong sectors? Well, definitely my hot or not report, but you need to do RSC to be able to do this and come up with standardized rules.
So a plug for, I just noticed you're using Beyond Charts there, which is...
I am using Beyond Charts,
also,
yes.
A good friend of mine over many, many years.
I've known the guy that developed that since 91. So,
absolutely.
yes.
So we're talking about Gary Stone.
Correct.
From Sherwell Systems, who is another legend of Australian trading. So can certainly recommend Beyond Charts as well as a software package which has that indicator in it.
Now, in terms of scale, this actually is separate from the discussion because what we're using is that RSC indicator. It applies its own indication over the top. So this is standardizing the scale and then applying which is outperforming which you can't do visually. If you overlay a chart over another chart, it is ignoring that scale situation. So that is important as well. So what we'll do is just do a quick snapshot of markets around the world. And what I'd like you to think about is, should you be involved in other markets at the moment? And then we're going to open it up for questions, and you can ask me anything. You know what is, even though this is the area that I really wanted to show you because I'm so excited about what this can mean for you, the areas in your trading plan, getting a trading plan in the first place, possible sector analysis, but you can take me anywhere with trading. I've really happy to go there. So feel free, think of your questions as I'm taking you through these markets so that we can make sure that we make use of the question time. Also think about whether the question's applicable just for you or whether it's applicable for the group. I will always favour a group-oriented question because you're community-minded that way. So no specific advice here. I'm using weekly charts, yes, because weekly charts gives me that broad macro view. I don't want to get too fine here. I don't want to get too detailed because you want that overall direction. I do trade short, but I don't trade short equities. The results that I've been able to attain from all of our traders, as well as external testing, shorting equities actually lowers your overall performance of your portfolio. So let's have a look at the markets around the world, and you can give me a bit of an idea about what you think. Are you willing to trade any of these? So if you see the chart that appeals to you, then you write into the little panel here, write into the chat and tell me what you like. All right, here's the NASDAQ. I'll give you my opinion, and then you can write whether you'd like to be involved yet. We're currently resting on support. We have got a series of lower highs. We are forming a descending triangle. Now, the interesting thing with a descending triangle is usually there'll be a breakout one way or another, usually in line with that angle of the top part of the triangle. And usually that occurs in the final third of that triangle. So currently, when we have a look at this, it is 6.78%. It is quite a volatile area, as you'd expect for the NASDAQ, but it definitely has been higher in the past. So there's the NASDAQ. Interesting little chart pattern there. Underneath its moving average, resting on support. Here's the S&P 500. Very similar look, slightly less volatility as a percentage. And we can also see here, it is right on support. So we are at a very critical time. The states definitely are going through some of the pain that we are feeling. And I do think it's an interesting time to be alive. If we can get some of these patterns into our brain, we can use them again in the future. Here's the Russell 2000. Have you seen a similarity? It really looks so similar, doesn't it? Underneath its moving average, series of lower highs, and with this volatility, 6.36%. So it is quite volatile. Anything over 5% anywhere around the world, I consider to be quite volatile, and based on its historical volatility as well. Now, this is the FTSE. The UK people are so calm and mild, and look at this for a calm and mild chart. Well, we have a sideways progression here, which makes for a change from those raging downtrends. We are under and then above and then under and then above the moving average, which is very typical for a sideways moving trend. But have a look at this beautiful area here where we've got a 2-line resistance area. So what this could open up opportunities for you is to possibly write call options over the top of that second resistance layer. So that can actually protect you because it is going to hit one resistance layer and it might turn around. If it hits a second one, sure, it might turn around. The odds of it busting through 2 layers, that is actually something that is less likely. And have a look at the volatility there. 3.27%. So the lowest that we've had with these charts that we've been looking at. So that is quite an interesting chart, something to consider. How are the French doing just across the pond? Wow, aren't they looking like the NASDAQ? And the S&P 500, this is what I found interesting. Looking at the charts this week, they are all forming similar patterns. That resting on support is very significant. Nearly 5% there in terms of volatility. We've got the DAX, there's the Germans. Look at that. They've just broken through that lower support level. Sure, they didn't close at or near their low. So we'd like to see for an extra few weeks whether that support is actually going to hold, just been drawn a little bit lower, or whether it's going to bust through just under the 5% volatility, which is interesting. Now, I'm going to open it up for some questions here. I know I've covered a lot, and I know a lot of you are interested in getting my special report so that you can go into more detail. I wrote that special report because today I knew we were going to have not enough time for me to cover every sector. So hopefully that will give you the specifics you need per sector. So I'd like to open it up for some questions.
One question we've missed from Sue. She was asking, what is the scale to the right of your RSC pane? Is it negative for XIJ? So
that scale, that is forced into the calculation of that indicator. So it standardizes out that scale because it has to think about the two things that you're comparing, create that standard scale. So that scale will be different every time you run that RSC over different instruments.
So it's more about the whether it's going up or down. Is that correct? And the position of the 30-period average over it.
Yeah. So let's just go back to one so that I can give you an exact example, and I'll give you my specific rule. All right, so this is the information technology, which is, goodness me.
So is it fair to say, Louise, the scale is almost irrelevant if we're looking at
the scale is irrelevant. Yes, right. Exactly. So I'll give you my rule, and then perhaps if there's questions about that rule, I'm open to you asking those questions. So we can see this blue line is the RSC on the lower part of the chart, and the green line, I've used an EMA 30 of that RSC line. So that's not of the share price action, that's actually of the RSC. Now, for me to classify something as a cold sector, what I'm looking at is that it's crossed below its moving average on the RSC for a minimum of 1 week, because we know that markets fall so fast and they take a long time to climb. So that saying of the bulls climb the stairs and the bears fall down the elevator shaft. So that's why it's a very stringent rule in terms of, do we stay away from this one? Now, in terms of when we're going up, I'm looking for the same type of look, but I'm looking for the RSC to be above its own moving average for a minimum of 5 weeks. It has to prove itself a little bit longer to be considered hot. So you can develop your own rules around this. The way to do it is to have a look at my rules first, though, and to see whether they make sense for you. And if they don't, you can manipulate that. That would be just fine. The key here, though, is that you have a rule, you work out what it is, you write it down, and you stick to it.
Yeah, it's very important. I think I'm a firm believer in the RSC as well. So, I mean, I think it's quite an independent technical tool, because so many technical tools are based upon price. Like, so you've got moving averages, you've got RSI. So a lot of people confuse the RSC, which is the relative strength comparative, with the RSI, relative strength index, and you've got MACDs, which are just moving averages. So many technical indicators are based upon price, yet this is based, okay, yes, price is involved, but it's not the price internally for the security, it's the price versus another security. And that other security is the index. So we're looking for outperformance or underperformance of the target versus your overall index. So
beautifully described.
Very important indicator, the RSC.
Yeah, and we don't have like a report for every part of the world, admittedly. I've focused on Australia for you because I believe, from what Carl's told me, most of you are trading Australian stocks. So that is something that I felt would give you the most value and benefit using the Australian market as a basis so that you can see my exact definitions, each index, what it's comprised of, what's in it, and how I've analysed it. So I do really feel that the Australian market is probably for this particular group. Who's trading elsewhere? Is there other markets other than Australia that you're trading? Pop it down in the chat so I can see. Might be able to give you some other pointers.
Guessing USA shares are
US,
very popular.
yeah.
People owning Tesla and Microsoft and Apple these days. So little plug for Think Markets. You can trade all of those markets on our platform as well. So there's a nice plug there.
Yeah. So quite a few trading US. So that's fantastic. So I do suggest then what you do is that you actually develop a macro for the US market. So I haven't got one pre-prepared here for you, but you can use my macro, put it across the US market, and then see whether this is something that you want to trade. So we've got things like the NASDAQ here. You can actually manipulate that rule because you can see with the NASDAQ, there is some higher percentage volatility times here that are still tradable. So if you're going to develop one of these rules for something like the NASDAQ, what you do is you wouldn't say 5%, you'd probably say something like 7%. And then you'd see how that fits in. A lot of this as well, just to make sure we've got our definitions straight, volatility is not trend. So the market can be going up in a very choppy way, all right, but the overall trend is up, but it's a volatile market. It can also be going down in that same way. I feel that the...
Sorry, I was just going to say, what really strikes me about the chart you've got on screen is that when volatility is trending lower, that's when you tend to see stocks trending higher. And when you see the pickup in volatility, you tend to get pretty close to the top in the stock market. The other thing I think it's important to just finish this point before we move on, Louise. If you are trading in the US, what should be your target for your RSE? What's your index that you suggest using there? Is it the S&P 500 or the NASDAQ, or depends on which stocks you trade?
I use the NASDAQ for that part, but also the S&P 500. So those are the two that I use. But some people do use the Russell 2000 as well. So it depends on what you see as the way you see the world. I tend to use the All Ords. A lot of people use ASX 200. The key is that you're using something, you're using it consistently, and it's really important that you manage to continue implementing it.
Okay. We've got the $1 million question from Sue. Do you feel the Aussie market may bottom later than the US market due to commodities?
I have no idea. I know that's not what you wanted to hear, but I'll always call a spade a spade. I follow my signals. I don't question. I don't look too far into the future. I don't try to predict. I don't try to imagine what could happen. I don't even listen to the news. And for some of you, that is sacrilege. I understand. But I find, having been a financial journalist in my past, do you know what they used to get me to do? Is they'd get me to write 2 articles. 1, BHP went up for all these reasons. 2, BHP went down for all of these reasons. And at the very last minute, we'd fill in that share price. So if you think about that, just in terms of the news, it's very possible that it's already factored into the share price action. So I just look at the charts. That's all I do. I don't look at fundamentals. I don't listen to anybody else. I focus on the charts.
We didn't actually talk about this at the start, did we? So look, I'm the same. The people, again, who know me know I'm the same, right? But as an analyst who gets up on the media and talks about stuff, I have to know the stuff as well, right? So I get up and I talk about the stuff, even though I know it makes absolutely no difference at all to the decisions you should be making as a trader. So the people who hang out with me know that I'm 100% technicals in my decision-making process. And here we are hearing today, everybody, Louise is 100% technical in her decision-making process as well. I wonder if there's something in that. So I know we've got a lot of news readers and watchers, and we often feel that the more information we take in, the smarter we're going to be, and therefore the better decisions we're going to make. Yet I find it's generally the opposite. The more information we take in, the more confused we get. and therefore the worse decisions we make. So having these sets of rules, and look, hey, you can have fundamental rules too, can't you, Louise? But having these rules based upon charts, what I love about the charts is nobody manipulates those. We don't have the Federal Reserve chairman or something manipulating the chart specifically. It's pure supply and demand. So charts are truth. That's what I say, and I base my rules therefore off the truth. And the people who are typing, I'm sure they're going to shout at me very soon. All the fundamentalists out there.
No, I'm loving it. Years ago, before I left my real job, I worked for a company called Dun & Bradstreet, which was credit information. Yes. And credit information is amazing because it has no impact on the share price action at all. So I was a national manager. I actually had a statistician working for me. We spent 6 months doing a study to try and work out, do fundamentals and does credit information have any impact on share price action? And there was zero correlation. So it's fascinating to see. We like things that feel tangible, and that's why fundamentals have taken off. So if you're using fundamentals and it works for you and it's telling you which shares to purchase, good, fine. That's good if you've got a reliable system that you've got written down, it's in your trading plan, and you can continually implement it.
That's the key, isn't it? Having those sets of rules. We've got the question: what trading platform do you use, Louise? Now, I'm not sure if that's with respect to where you actually place your trades, and I'm sure that's with Think Markets, but maybe where you do your analysis, perhaps.
Yeah. Look, you can, if you don't have a charting package, you can use Yahoo Finance, and it has got a load of different indicators you can apply. So other than that, I'm using Beyond Charts, and Think Markets has got everything that you could possibly need. So you really don't need to look further afield. You've got somebody who cares for you enough to run a webinar so that you can be introduced to these types of concepts to protect your portfolio and to make sure that you stay around long enough to work this thing out. So be careful about spreading yourself too thin with marketing platforms, because they can sell a big game, but are you going to get somebody of Carl's caliber?
Yeah, look, I can definitely recommend Beyond Charts. So people in my webinars know I use Amy Broker, which is probably sacrilege. I should get onto Beyond Charts as well, because Gary and I are old friends. But I can certainly recommend that. It does everything that my Amy Broker does. So happy to get on that with Louise. What percentages do you set stop losses at?
I don't use a percentage, actually. I use the average true range to guide me. So I look at the average true range and I use a multiple of average true range, and I use 3 ATR for my initial stop. When it goes to break even, I use 3 ATR. And then once I'm in a trailing situation, I move to 5 ATR.
So it's a volatility-based stop loss. That's the important part there. It's not based upon a percentage. Because if we say, let's look at Square, so block, so the old Afterpay, of course, and think about what the volatility on that might be compared to, say, Telstra. So if we were to use a percentage model where we said 5% on both stocks, if you used 5% on block, you'd be stopped out in five seconds. Whereas in Telstra, you might not be stopped out for 12 months. So yeah, be careful on that. Louise is using a volatility-based stop loss, and the tool she uses to measure the volatility is the average true range.
Beautiful. So there's a few TradingView people here, which is great. It's nice that it's free. Mixing fundamental analysis with technical analysis is just fine, but make sure you've got those definitive rules. Technical analysis is great as a timing tool. So you might use the which question to be answered by fundamental analysis and the when question to be answered by technical analysis. Now, you're not the only one to get confused by the news, Kim. No, everybody gets confused by the news, and you know what it does? It scares them out of positions they should stay in. That's the danger. So sure, it may stimulate you to get into a position. If you've got a stop loss, that's fine. But we know every year with good traders, even with market wizards, there's only 3 or 4 trades every single year that make their entire year, myself included. If I miss out on those trades because I'm scared out of a position, then shame on me, because I shouldn't have listened to the news. So I do think that that is important. Yeah. Okay. Now, the EMA for the NASDAQ is only 5, not 30. Let's have a look. Now, this 5, you're right, Samantha, well spotted, that this is over the top of the percentage, not the RSC. So that's the average true range volatility percentage, and I use an EMA 5 over the top of the ATRV. Yeah.
And look, the obvious question is, hey, Louise, why do you use a 5 for that one and a 30 for the other one?
That is a good question. The reason is because if we use a 30, which is much flatter in terms of reactivity, using something like the percentage, trying to develop specific rules, is I'm actually using the ATRV line itself. So you can see the figure that I read off for the NASDAQ was 6.78%. I'm actually using the ATRV figure to guide me in terms of that percentage. The EMA 5 is just to get an idea, is it going up or down, and have a definitive rule. So if it's trending above its own moving average, that volatility is increasing. Otherwise, I don't have a standard visual way to say that it's going up or down in terms of volatility.
Yeah, we want some smoothing, because the volatility line's, as the name suggests, quite volatile. So you just want to smooth it out. And I think, look, the other answer, I don't want to speak on your behalf, Louise, but the other answer is because it works, right? I mean, you choose as a technical analyst, you pick the indicators which you find work over a long period of time. So the reason why one's 5 and one's 30 is because that's what you found has worked.
That's exactly right. And I think the thing is that for you to play around with it yourself, you can take mine. I would love you to take my settings and just see how it sits. And if it doesn't sit well, then definitely reconsider and play with it yourself. The key is that you want this in line with your own internal beliefs. The difficulty is if you've got your certain values and certain beliefs and you're using a trading plan that doesn't fit, that's where the difficulties lie. And that's why I usually suggest don't just buy a trading plan system off the shelf. Don't buy somebody else's hopes and views in their trading plan system and adopt them as your own unless you really have those beliefs as well.
Okay, we might have to make this the last one, just seeing how we're going on time. Do you trade daily, weekly? How often do you look at the market? And actually, this is probably one of the best questions, I think, today.
Yeah, look, I trade mainly on a weekly chart. I've broken my equity down into 3 buckets. And in those 3 buckets, you've heard about the 10% bucket where I'll go against the predominant trend with a small amount of my money. I've also got the weekly as being the bulk of my money that I trade, but I also have some shorter term trades that I use as well, depending on the circumstance in my own life. I find for me currently, I'm very happy to take a slight step back, use a broader time perspective. I know that the money comes from my medium-term trading throughout the years. I know that this is backed by research as well, that the majority of our wealth is created from medium-term, not from short-term. So for me, short-term is when I've got an itch I want to scratch and when I have time in my life. And currently the market, from everything that I've developed here, and hopefully you can see that there's a systematic view, is it's not ready for me to be short-term trading. I've got to wait for a better signal. So the ones that I'm in and I'm happy with, I stick to my stops. Otherwise, hey, I'm standing aside.
I think, Nandish, the question was asked before, do you go short? And Louise said that not on specific stocks. Does that mean you short the index?
Correct.
Then? Yes, correct. So
I can definitely short indexes. The index shorting that I do, a lot of it is to do with options as well. Just as I said, that footsie play could be a very nice topical one, but you don't really always have to think in both directions. It's okay if you're already well set up and established financially to be one-sided. You can do that. So there are no have-tos with this. Absolutely. That's certainly what suits me. So I've been active trading before where I've been in and out, even 2-minute charts. I didn't make any more money following a 2-minute chart than I do following a weekly chart.
Okay. Well, unfortunately, we do have to wrap it there. I know we could go on and on, but perhaps we'll try and get you back at another stage then, Louise, because I'm sure we'll have plenty of people who will have questions. But thank you for your time. I know your time is valuable, and I know when trying to set this up, it was trying to fit you in was a problem. I know how busy you are, so we really appreciate it. On behalf of everybody, thank you so much for sharing your knowledge. Everybody, if I knew how to, I'd switch the screen back to me, but I can't. I can't figure it out.
Thank you so much for everybody's wonderful questions and your enthusiasm. I have just loved being here so much. And really, can we give a big thanks to Carl, because you organised the whole lot. Look at you, you did it.
I'm back.
So, look, really having such a long-term relationship and friendship with you, Carl, I just so appreciate that you are allowing me access to your people who I know you care for and that you want the very best for. So well done, everybody, and enjoy your day.
Yeah, absolutely. That's why I got you in. Okay. Thanks, everybody. All the best for your trading, investing. Till we catch up again. Bye-bye for now.